How export capacity influences currency strength. Welcome to IQD to VND. Hey everyone, welcome back to IQD to VND. If you haven't already, hit that subscribe button and help us reach 300 subscribers in just 19 days. Now, imagine if your country's currency strength could be boosted by increasing its exports. Sounds interesting, right? Today, we're diving deep into an important economic concept: how export capacity impacts currency value. We'll break it down in a simple way, so you can understand why exports play a crucial role in determining a country's economic stability. So, stay with us as we explore this key aspect of the global economy. Understanding currency exchange rates. Before we dive into exports, let's first understand currency exchange rates. In simple terms, an exchange rate shows how much one currency is worth compared to another. For example, how many Iraqi dinars, IQD, you need to buy $1, USD. There are two main types of exchange rates. One, floating exchange rates. These rates fluctuate based on market conditions, just like the prices of goods and services. Supply and demand drive these changes. Two, fixed exchange rates. These are controlled by central banks or governments, meaning they do not fluctuate freely in the open market. According to Dr. Mazhar Mohammed Salah, a financial advisor to the Iraqi Prime Minister, both floating and fixed rates play a significant role in economic stability. Countries use them strategically to manage inflation, trade, and investments. But what really determines the strength of a currency? Let's break it down. Key factors that affect currency strength. Several factors influence whether a currency gains or loses value. 1. Supply and demand. Like any product, when demand is high, the value of a currency rises. If more people need a currency for trade or investment, its price goes up. On the other hand, if demand falls, the value drops. 2. Interest rates. Higher interest rates attract foreign investors because they can earn more on their investments. When foreign investors buy assets in a country, they need to exchange their currency for the local currency, increasing its demand and strength. 3. Inflation rates. High inflation reduces a currency's purchasing power. If inflation rises too fast, a single unit of currency buys less than before, causing people to lose confidence in it. This often leads to currency devaluation. 4. Economic growth. A country with a strong economy attracts investments, which increases demand for its currency. This is where exports play a crucial role. How exports strengthen a country's currency. A nation that exports more goods and services creates jobs, generates income, drives economic growth, attracts foreign investment. Let's look at two scenarios. Country A, strong exports, produces high-quality products that sell globally, increasing foreign currency inflow. The economy grows, interest rates rise, and the currency strengthens. Country B, weak exports, struggles to sell its products abroad, leading to low foreign investment. High inflation, weak growth, and low demand for its currency cause its value to decline. A strong currency benefits consumers by making imported goods cheaper, while a weak currency makes foreign products more expensive. Government strategies to boost exports and strengthen currency. Governments can take several actions to improve export capacity, including investing in research and development, R&D. Innovation leads to better products, making them more competitive globally. Developing skilled labor. Training programs create a highly skilled workforce, improving product quality and efficiency. Negotiating trade. Agreements, reducing tariffs and trade barriers makes it easier to sell goods internationally. By improving export capacity, a country attracts foreign investment, stimulates economic growth, and boosts its currency value. The impact of dropping zeros on currency stability. Another interesting economic strategy is dropping zeros from currency. This means removing 3 or more zeros from banknotes to simplify transactions and stabilize the economy. This process often happens in countries dealing with hyperinflation or undergoing economic reforms. Example: Turkey's currency reform. In 2005, Turkey removed 6 zeros from the lira. This move restored confidence in their economy. It helped attract foreign investment and stabilized prices. But dropping zeros alone isn't enough. The government must also implement other economic reforms to make the change successful. Otherwise, people might panic, leading to economic instability instead of improvement. The role of insurance companies, like K2 in currency changes. Companies like K2 Insurance help banks and businesses manage financial risks during currency changes. If a currency suddenly loses value, K2 provides coverage to protect financial institutions. K2 ensures that Czech banks stay stable during currency transitions. People understand the impact of dropping zeros. The financial system remains secure. What can you do as an individual? Now that you understand how exports impact currency strength, here's how you can stay informed and contribute. Follow economic news. Keep an eye on trade policies and currency updates. Support local industries. Buying locally made products helps strengthen exports. Advocate for economic policies. Support policies that boost exports and workforce development. Final thoughts. To sum up, a country's export capacity directly affects its currency strength. The higher the demand for a country's goods, the stronger its currency. Government policies, investments, and trade agreements play a huge role in shaping economic success. Dropping zeros can help stabilize inflation, but only when combined with other economic reforms. Understanding these principles can help you make smarter financial decisions. What do you think? How does your country's currency strength affect your daily life? Let us know in the comments. And don't forget to like, separate, share, and subscribe for more valuable insights into currencies, exports, and global economies. Stay informed, stay ahead.